Things have changed hugely, but it's just that, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things, which are not directly, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things, which are not directly related.
If you're not paying attention now, you'll feel the shock when the reset hits. Alasdair Macleod just revealed something alarming. The same stress signals that appeared right before the 2008 crash are flashing again. But this time, the bubble is bigger, the leverage is crazier, and the world is quietly preparing to leave the dollar behind. Central banks are hoarding gold, BRICS is building a new settlement system, and China is setting up gold convertible trade. All while our financial markets sit on a credit bomb nobody wants to talk about. And Macleod's warning is simple. When this bubble pops, paper wealth evaporates. But physical gold and silver don't wait for permission to revalue.
Yeah, it does make a huge difference, because the central banks undoubtedly will be in there buying any physical gold that comes on offer. And I think the answer is there won't be any coming on offer. It'll all be in the paper markets. That's where the volatility will be, if you like. But interestingly, if you look at the open interest in COMEX at the moment, just to take futures market, it's sort of not that high. I mean, it's sort of averaged to slightly less than average, which suggests that the amount of speculation, the amount of, if you like, momentum trading, speculative trading, and so on and so forth, in the futures market is actually not all that great. So, the idea that they could sort of maybe bash it down and really shake the trees, as it were, get out to all the loose holders, that doesn't really apply in this situation. So it is a fundamentally different situation. And of course, the other thing is that, I think this is a topic you might like to follow up on. China is definitely making a move to make gold exchangeable for yuan by opening vaults outside China. SGE vaults are being opened in Hong Kong and also in Saudi Arabia, and there will be facilities in other Southeast Asian nations. So the whole of the BRICS cohort, as it were, will be looking at a situation where, for trade purposes anyway, the yuan and gold will be exchangeable, and presumably at some stage in the future there will be a fixed exchange rate. So if you're an African central bank, it does make sense that you've got to start accumulating a bit of gold. If you've got mines in your territory which produce it, you'll hang on to it, which will leave the market short. If, on the other hand, you haven't, then you've got to go into the market and try and get some. So I can see that central bank demand for gold is probably going to accelerate. And the other side of it is that following the debacle earlier this year, when the Bank of England had a rush on its vaulted stocks, I think the central banks who saw their leased gold walking out of the door will think, I don't think we really want to do this in future. So I think you'll find that gold leases, which are essential for the liquidity of the forward market in London, I think the availability of those leases is going to diminish. I suspect it's already diminishing. And I think that the bullion banks are already aware of this, which is why they're quite happy to talk the price of gold up now, just as the major banks are. You get Morgan Stanley and so on now openly talking about higher gold prices and talking about, well, you should have 20% in gold, I think, in the case of Morgan Stanley. Things have changed hugely, but it's just that, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things, which are not directly. And, I've been saying for some time on your program, I would get out of credit and get into real money, which is gold. And interestingly, once this market turns, once the bubble gets popped and stocks really start sliding, virtually everything will go with it. So if you've got mining shares, you'll probably find they get quite a lot cheaper in the process. Nothing to do with gold or silver, but just to do with the general distress in the market. Gold and silver, last time this happened, we were looking at the great financial crisis, 2008, 2009. Gold was sold down from $1,000 down to about $680. So it then went on after that to go up to $1,920, which was a significant move, once the immediate crisis had passed. But we could have the same thing today, but I think it's less likely because central banks are in there taking opportunity. Any stock that comes out, they will buy. So I think that the physical market, it's unlikely to suffer the sort of problems that we saw in late 2008 and into 2009. Mining stocks could be different, though, because there are some very substantial profits there. And what people do when things start going wrong is rather than sell the things that, and realizing losses, what they do is they hang on to the rubbish that they're making losses on and sell the good stuff, which will be mines, of course. So I think we could be in for a period of enormous volatility. And I think it's important to understand why that volatility is there. And then you could probably...
Could you first talk to us about the nervousness that you're seeing in the markets?
There are sort of mixture of things going on. I mean, we've had no statistics out of the US government that, not quite no statistics, but certainly statistics that people follow, like employment statistics and so on and so forth. They've been suspended. They're about to come back. There's nervousness that those statistics might show that the economy isn't performing as well as people hope or think. On top of that, of course, we've seen Bitcoin fall very, very substantially. I mean, remember at one point it was $126. Today it dipped below $90, though it's recovered a little bit since then. There's been a sort of talk about the Magnificent Seven and how they seem to be losing momentum, sort of concerns there and so on. So there is this nervousness. But underlying it all, of course, is the condition, the overall condition, and that is one of a credit bubble fueled by bank credit, the expansion of bank credit to, if you like, help people buy stocks and thereby drive their prices up. We had released earlier this week, I think it was late, maybe at the weekend, the FINRA's margin lending figures. And they're now about 1.2 trillion. That was the October number, end October. Now, bear in mind that that's only brokers lending to their clients, margin lending. Now, some of that they will have done out of their own resources. Remember that a broker can't actually lend credit into existence. That is, you have to be a licensed bank to do that. So where a broker doesn't do it out of his own resources, he will do it out of a bank. He will draw down on a client's loan account. It'd probably be a general loan account with a banker. But on top of that, of course, you've got hedge funds and you've got the sort of very large institutions, the very large family offices. Some of them will have gone to the banks in order to leverage up their positions. So the idea that there's about 1.1 trillion, 1.2 trillion of margin debt actually only tells part of the story. A far larger amount is being loaned and we don't see it because it's not recorded in those FINRA statistics. And, when a bank or a broker lends a customer a credit on margin, I mean, it's usually to buy about 3 times as much stock. So there could be, on FINRA alone, that's about $3 trillion worth of stock. And then with the banks, I don't know, you could probably take a guess. You probably at least double that again. So we could indeed have up to 10 trillion of stock being held on margin. Now, if that's the case, falling values, and I would include Bitcoin in this, are likely to trigger automatic selling, if you like, as the value of collateral backing those loans diminishes. So you can see it's quite a febrile situation. if you look at Bitcoin, I mean, falling from 126 down to 90 odd, I mean, that's over 25% fall. And there are some very leveraged positions in that. So you could get, if you like, an avalanche of sellers developing if that situation gets worse. Now, we don't know for certain that this is the end of, if you like, the credit bubble, because one of the things the Fed was doing was it was changing its policy from trying to control inflation to, if you like, providing liquidity in the system. And to that end, it has announced the end of QT and the beginning of QE. So, the credit machine is going to get cranked up again, another notch. But whether it's enough to save the equity market, we will see. We don't know yet. We always know these things in hindsight. But I think the general point is that holding stocks is getting a very, very dangerous game.
If Alasdair Macleod is right, then the window to protect yourself is closing faster than anyone realizes. Don't walk away from this video without securing your own understanding. If you found value today, just tap the like button. It helps more people see the truth they're not being told. And if you want to stay ahead of the reset, subscribe and gently hit the bell icon so you never miss the next warning before it hits the world. Stay informed, stay prepared, and stay safe.